Good afternoon. Thank you for joining us for today's webinar, where we will discuss CECL and in particular our CECLSolver. My name is Sean O'Brien, the president of QwickRate, and I'm joined by Steve Huntington. Steve's the director of analytics here at QwickRate and QwickAnalytics, and we'll walk you through our CECLSolver tool today. Just a couple of housekeeping items before we get going. One, we will send out a copy of today's presentation along with a link to the recording, probably either later today or tomorrow, more likely tomorrow. We will send that out so you don't have to worry about if you have to break away or if you want to get a copy of the slides. Just a reminder, QwickRate, obviously we thank all of you for attending these webinars. We thank you for working with us for over 35 years. And certainly we've tried to continue to evolve and bring you new solutions, including QwickAnalytics and IntelliCredit, and the CECLSolver is part of QwickAnalytics. Our big focus here is to do the work of aggregating data so you can do your work analyzing data and feel like we can bring some efficiencies to a number of processes, obviously here with CECL, but in IntelliCredit, obviously with external and internal and even annual loan reviews. So if you haven't looked at any of these beyond the CECLSolver, we certainly encourage you to do so. We won't touch on this. Obviously, we're pulling data from a number of sources, all again designed to free you up to spend your time where we think it should be focused analyzing the data. We provide a number of things in addition to the CECLSolver. So while a QwickAnalytics subscription will get you our CECLSolver, it will also give you and your bank team quite a bit else. So we encourage you to call us or email us for a demo, and we can take you through it all. All right, let's talk about CECL. I think it's important to keep in mind, even though the standard is changing, what we're trying to do. Reserves are designed to cover expected losses. Capital is there to address unexpected losses. I think that's important to keep in mind. We are in many ways playing the same game with a new set of rules. Commonly, we are asked what was wrong with the ACCL, the incurred loss model. Really, there probably wasn't really anything dramatically wrong with it until the financial crisis, where a number of deficiencies were exposed. And if you are the Federal Accounting Standards Board, FASB, something doesn't work, you really have two choices, right? You can either do nothing or make a change. They made the change. CECL is that change. But again, let's not lose sight of the fact, all we're really doing is playing the same game now with a new set of rules. There are a number of similarities to, between, what we're doing in CECL and the incurred loss model. But I think the important difference is that we're going to be looking at losses over a much longer period of time, right? Typically in the ACCL, we look at losses on an annualized or a very shorter term horizon. CECL wants you to look at over more of a lifetime of losses. And in our case, we kind of have as a proxy for that, the WARM methodology. So we'll discuss that. But again, these are some of the things that that we're talking about with the change in rules, right? There's a lot of similarities, but there are a few different things that we're going to calculate differently that we'll show you here today. We've come a long way since December 16, when CECL officially was introduced and became the standard and the timeline was introduced. A lot of that has been, I think, favorable for community banks. A lot of the theoretical considerations that that were initially put out there have been replaced by practical realities, which again, I think have all worked in the favor of community banks, and we'll touch on a couple of those. I think first and foremost was the reaffirmation or confirmation by the regulators that small banks don't need big models. Jeff Gear, who's the Associate Chief Accountant for the OCC and kind of heads up their CECL focus, has repeatedly said at every presentation or conference I've heard him speak that community banks should not overcomplicate this. It is scalable in the sense that the burden for the bank is certainly commensurate with the size and complexity of your institution. We still have time to do parallel runs. This will become, effectively operational with the first call report filing in 2023. So, don't feel too alarmed if you're just getting started. There's still plenty of time to get you up and going. I think expectations are as with everything in life, are important. I think these have been, kind of reset over the last couple of years. I think we want and we focus on trying to be very practical and very realistic in our approach to CECL. I think, one of the benefits that has clearly been acknowledged and reinforced is that the more constrained your bank is by data availability, the more straightforward CECL gets. In other words, you can only do and work with the data you have. And for most community banks, that involves call report data. Most community banks do not have a decade's worth of loan level information residing in their core. Any attempt to do CECL at the loan level there is really kind of, impractical and, just not going to be worth the time and effort to do it. The regulators have realized that and have certainly been accepting and even, kind of pushing community banks towards call report based solutions that and one of them which we'll show you here today. I think another really practical consideration is we are trying to be accurate, not precise. There are a number of different things within CECL where you can go down rabbit holes. We try to, coach you to not do that. Again, remember our objective. We're trying to establish a reserve on what we think the expected losses are going to be in our loan portfolio. That's what we're trying to focus in on. And so typically for most community banks, the most practical way to think about that is to look back at your historical losses and then plus or minus your Q factors arrive at a reserve. If you've had the good fortune of not having any losses, peer data can be a supplemental source of information that, again, the call report can assist you with, and our tools certainly assist you with, but has also been very accepting by the regulators. So again, we're going to, show you how our tool can, we think in many ways just really take a lot of the anxiety out of CECL. There is no mandatory method. There is no one way to do this. There are a number of different ways to do it. Again, we focused on, particularly for our audience, community banks, usually under $1 billion. We certainly have some over $1 billion, but, that for those that didn't necessarily need a very complex or, detailed model, you don't need that to satisfy CECL. So again, if you're just getting started, don't worry. We can get you to the finish line. I think for all of those reasons and a number of others is why we introduced the CECLSolver. We felt like we could really provide a resource to our banks, particularly in aggregating all of that historical call report information. And so that is probably the single biggest benefit that we do provide is we organize your information, in a way that you can very quickly jump in and begin to do the analysis. We have a number of resources. We don't want you to take our word for all of this. Within our solution, we have links to presentations done by the regulators, done by FASB, that specifically address how community banks can solve and satisfy the CECL standard. We've got those links out there, so if you ever want to, you can dive in and actually see the presentations going back a few years that the regulators have made regarding this. Okay, so at this point, I am going to turn the presentation over to Steve. He is actually going to walk you through our CECLSolver. Steve, the screen is yours.
Thank you, Sean. Give me a moment just to pull this up.
Sure.
Let me know when that pops up.
I can see your screen.
Excellent. Thanks again for joining us this afternoon, everybody. What you see in front of you right now is exactly pretty much the way the tool would look as soon as you would log in and start working on it with your institution. We picked a sample institution for today. It's a larger community bank out of the Northeast. But the first thing that you'll notice when you pull up the tool is how we've segmented the loan portfolio. As Sean mentioned, the call report is the way that we organize the segmentation, at least by default. And the reason we do that is because it gives us access to a treasure trove of historical data coming directly from the call reports with consistent segmentation, both within your bank as well as within your peer group, so that we can gather historical trends on balances, charge-offs, recoveries, past dues by segment going back, an entire economic cycle or further, and preload all that into the system so that when you first log in, all that data is already there for you. And it gets updated as soon as you file your call reports and as soon as your peers file their call reports every quarter. So again, so that you spend your time focusing on the subjective elements of CECL, your qualitative factors, and where your time should be spent instead of endlessly reconciling and re-reconciling data. The other thing you'll notice is that we're heavily utilizing the weighted average remaining maturity method, or the WARM method for short, for CECL. Certainly one of the more straightforward methodologies that's been vetted and approved by the regulators and auditors for CECL compliance for the vast majority of community banks out there. There are some elements of other methodologies, most notably the snapshot open pool methodology, but certainly for the most part a WARM-based methodology that we have prepared. The first step in utilizing the tool, and whether you're using a WARM-based approach or really any methodology for CECL, this is a calculation that you can't really get around having to do, are getting a handle around the remaining maturities that you have by risk pool. Again, since CECL is all about estimating losses over the remaining lives of the pools, we have to get a feel for what those remaining lives are. And since we're starting with the call report buckets or segmentation, we ask that you plug in some weighted average remaining maturities by call report bucket. Now, this is a critical input into the tool, and it is not a value that we can get, at least directly, from the call reports. Nowhere on the call reports does it ask you guys to do a remaining maturity calculation. So there's a number of ways we can assist you with that in utilizing the tool, whether you can request the remaining maturity calculations from your core or ALM. That's certainly an easy way to do it. A lot of times we don't get a whole lot of help from that end, and then we're left either having you guys calculate it internally with help from us, or setting up a situation where you can upload your data, loan level data, in a secure environment, and then we can calculate the WARMs completely for you on an ongoing basis for use in the CECL tool. So rest assured, as much assistance as you need in getting those WARM calculations sort of on the front end here, we can provide. We have an Excel-based tool here which shows you, if you were handling the WARM calculations, exactly how you would cut and paste, so to speak, your loan level data into that Excel file and handle the WARM calculations. If we were doing them for you, we would be providing you with an Excel spreadsheet with all your loan data organized by call report bucket and the WARM calculations sort of in there on a quarterly basis. Let's go ahead and plug a WARM calculation. I've gone ahead and plugged in some random values here just for illustrative purposes, but let's pick a guinea pig for today, and let's go with the other non-farm, non-residential. Let's say that we had calculated the average remaining life of our other non-farm, non-residential loans was 3.75 years. We plug that in there. It takes about a second, and then everything just recalculated across the board on the fly as it pertains to the other non-farm, non-residential loans for CECL. What I mean by all that is, if we know that the WARM of our other non-farm, non-residential is 3.75 years, what CECL is really demanding of us is that we project 3.75 years worth of potential future losses on that segment, right? Losses over the remaining life of the pool. So in order to start projecting 3 3/4 years in the future, our tool starts by looking at a 3.75 year period in the past. So we take a symmetrical view of the look back period, at least by default. And we analyze your balance changes, your charge-off history and trends, your recoveries. So you take all that historical information to calculate the first big piece of the puzzle for CECL, and that is, what is our bank's historical lifetime or life of the loan loss rate on that particular pool? So for other non-farm, non-residential, this is an excellent example of using a lot of external peer data to help out. This bank hasn't had any losses. In fact, they've had net recoveries over the last 3.75 years in aggregate. Obviously, there's a lot of data that goes into this historical lifetime loss rate. Lucky for us that using the WARM method in general and our take on it specifically, it's relatively straightforward, and all the supporting details that go into that lifetime loss rate are found right here in the historical analysis tab. So again, when you first log into the tool, all of this historical data on your bank is going to be sitting right here waiting for you. None of this is information that you have to upload on a one-time or recurring basis. So first thing we're going to analyze are balances. So we see again for the other non-farm, non-residential, they've got a good sized portfolio, $600–700 million plus or minus. We can go back in time and look further into history if we want to. But you'll notice we're highlighting the last 3.75 years. We've shaded it in blue or almost turquoisey there. And that just gives us a visual representation of the different durations or look back periods that we're working with. And over that 3.75 years, this bank has averaged about $750 million in other non-farm, non-residential. Next thing we'll do is take a look at the charge-off history. So we see here for other non-farm, non-residential, there have had some charge-offs, but it's been quite manageable, a couple $100,000 worth over the last few years in aggregate. And then we'll expand the gross recovery so we can see that trend as well, usually lagging. Yep, so that we saw a big recovery in 2020 of some of those losses that they saw in 18 and 19. And so if we head down to the bottom, where the rubber really meets the road is in the net charge-offs. So we see net charge-offs have actually been negligible or even net recoveries over the look-back period, which is not by any means a unique situation, and we'll discuss how we want to manage that in just a second. And we can toggle over to see ratios as well as dollar amounts, and again, go back in time further than we need to. And so we see the aggregate loss rate for the bank over that look-back period is actually negative. So if I head back up to the summary page, that's where this value right here, the historical lifetime loss rate, comes from. Now, at this point, we've sort of tackled half the job. We haven't looked outside our four walls. We haven't considered peer data, any external data. We haven't considered how the future might be different than the past, but we have done a full analysis of our historical loss experience. The second piece of the puzzle, the second half really, is all the qualitative factor adjustments, right? That cumulatively represent all the reasons we think current and future conditions might be a little bit different than the historical ones that we just analyzed. And this is where we head over to the Q factors tab. So you'll notice when I click on the Q factors tab here, you see all these different columns. Each one represents a different qualitative factor adjustment that the bank can take or can make on their historical life to adjust their historical lifetime loss rate in order to get to where you think we're gonna be moving forward. So we see our historical lifetime loss rates here, and then the various adjustments. I've plugged a couple sample adjustments in here. So let's say for the first lien mortgages, they had historical loss rate of 39 basis points, and we made some adjustments based upon economic conditions, other external factors. You'll notice that these qualitative factor adjustments in this section here mirror or match the suggested adjustments that comes from the current interagency regulatory guidance on loan loss reserve accounting. So these Q factors are not a new concept by any means. These are a lot of the adjustments that you've been asked or to at least consider in your current loan loss reserve accounting process under the incurred loss methodology. So this is a part of CECL, which really doesn't have to be conceptually very different from what you're doing right now. You don't have to make adjustments for each of these different factors, but you do have to consider whether an adjustment would be appropriate. If there are no adjustments for changes in lending management or staff, then you can remove that entire qualitative factor right there, like I just did. You can also add additional custom factors here I can come here and I can add a completely custom Q factor adjustment, label it however I want, and make additional adjustments. And you can modify these as you go as well. So you have a lot of flexibility here in the qualitative factor adjustments that you make. And once you've made all of your adjustments, then the net adjustment shows up here on the column on the right and is brought forward back to the summary results tab. One of the things you'll notice about the way our tool works, the entire tool lives in the cloud, meaning that as soon as you make any sort of changes in inputs or assumptions, the entire tool recalculates pretty much instantaneously on the fly. So you get immediate feedback about whether that change in assumption or input really moves the needle or has any significant change in your CECL reserve that's required for that segment or for the entire portfolio. So across the board, everything updates in real time, which allows you to do a lot of what if analysis and creating different scenarios very quickly and realizing what's really going to make a difference and what is pretty irrelevant, which pretty quickly you'll find ends up saving you a lot of time and energy, because if you spend huge amounts of time, sharpening the point on one particular assumption, only to find out that whether that assumption was dead on or way off, because of your situation and math, it really doesn't make a hill of beans of difference in the overall calculation. You know that was probably not time well spent. And so you can quickly get to the assumptions that really matter to your bank. But also, again, if you change your Q factors, you go back to the summary, all the pages are linked and synced in a real-time environment. Also, you can click through the portfolio, and as you click on a segment of the portfolio, you get kind of a real-time summary chart here on the right, which summarizes all the most important elements of CECL really in one page or on one chart. If I click on the first lien, I can see my bank's long-term trend in losses. Those are the blue bars. The peer group's long-term trend in losses, that's the green line. The gray shaded area here represents the look-back period that we're using to start estimating CECL. And then the orange line is the current CECL estimate based upon those assumptions. So if I were to come in here and change an assumption, you can see that the CECL estimate pretty much updated right away, and that chart kind of updates on the fly. You can also go ahead and change to look not just at net charge-offs, but if you'd like to go upstream and see some of the more emerging credit trends, you can click on non-accrual loans, and that'll give you the same trend for your bank, your peer group, and compare long-term non-accrual trends to what your reserve would need to be under CECL, or even all the way upstream. The first place where credit issues are going to show up publicly on the call reports is in that 30 to 89 days. So we can go upstream even further and see what those trends look like compared to the peer group and compared to the CECL reserve. This is also here in a very important administrative feature of the tool that allows you to, this is where you start building your narrative, right? Your justification or explanation for why you made the adjustments that you made for your qualitative factors. And I'd say that, from everything we've heard from FASB, from the regulators, from or the auditors, is that it's all about documenting, making reasonable assumptions and documenting them. So it's really not, from that perspective, very different from what we've always been doing under for loan loss reserve accounting. And that is, it's probably less important whether the adjustment was 40 basis points or 50 basis points, and much more important that you have an explanation of where that number came from and you can justify it. So this allows you to make notes on your adjustments and attach them to each risk pool separately and individually. Whenever you make those notes, they get saved whenever you print off or save a scenario or export it, so that not only you have a paper trail for your auditors and examiners to follow about your explanations and justifications, but also when you come back in here next month, next quarter to update it, you'll be reminded of exactly what you were thinking when you made the adjustments last time, and you can make appropriate modifications to it. Heading back to the summary here, one place where, one of the more important data points that we have to consider for qualitative factor adjustments are environmental factors, right? Looking outside of our four walls to the environment around us. And the best way that we can give you data so that you can do that on an apples to apples basis is to look at peer data but look at it in a way that's extremely comparable to the way we did the calculations for your bank. And what I mean by that is when we were doing this historical analysis on your bank, when we were looking at, tracking balances, balance changes, tracking the accumulation of charge-offs over time and recoveries, and doing it over all these custom look-back periods, we were actually doing this entire analysis on every single other bank in your peer group simultaneously in the background. So just crunching literally millions of data points from the call reports of your peers in order to get this. What this page represents is if we did that analysis for all of your peers and aggregated it and then weighted average them by period and then overlaid your look back periods on top of it, we would get this page. So it represents average loss rates by segment using the same segmentation we're using for you, but for all the banks in the peer group. So we can calculate, in effect, a average lifetime loss rate based upon your WARMs for the banks in your peer group, which is a perfectly sort of apples to apples comparison to your historical loss rate. So when you're in a situation like this, where for the other non-farm, non-residential loans, you have absolutely no net charge-offs, in fact, net recoveries over a relatively long historical look-back period, we know we're not going to get away with having no reserve for that $750 million portfolio of CRE loans. But we can't just use our own historical trends to justify whatever we come up with. So now we can say, hey, we didn't just look at our CRE, we looked at all the other non-farm, non-residential loans for all the community banks in our state over that exact same 3.75-year historical period, and found that they averaged a total of about 16 basis points in losses over that same time frame. Now we can use that apples to apples comparison to make an adjustment, a Q factor adjustment right here, and to the tune of, however much we want to take it into account, right? We're not going to necessarily assume that we're going to ignore how well we performed and simply make a Q factor so that we expect to perform exactly as our peers, but we can certainly now justify making an adjustment in the direction of our peers. And we give you the data so that you can justify that. So that's how the qualitative factor adjustment process works using our tool. Once you've finished that process, the net adjustment shows up right here on the summary page. And then the expected future loss rate is simply our historical experience plus or minus the sum total of all of our adjustments to it is equal to that future loss rate. And we want to take that lifetime loss rate and apply it to our current portfolio balance in order to calculate a CECL reserve. Now, by default, this current balance column is going to have in it whatever we had on our most recent call report, right? That's the only thing that the tool has access to by default based on public information. However, that does not at all in any way limit how often you run this tool or when you run it as of. You'll notice all the current balances are overridable, so you can come in here anytime and override those quarter end balances with month end or yesterday's GL balance if you decide. And then the calculation, the CECL calculation, will be as of whatever date you plugged in overrode these values. This would also be where you'd make any adjustments to your portfolio for any loans that are balances that are outside the scope of CECL completely. Whether you still have some PPP loans on the books hiding over in C&I, you can make an adjustment here, and then you can make a note of it right here. Or if you have any loans held for sale on the books at fair market value, anything that's not within the scope of CECL for our reserve calculation, we can net those out there. And then the last piece of the puzzle is to deal with any loans that we feel that we need to individually assess. Certainly a bit of a gray area now as to what the threshold is going to be under CECL for individually assessing loans. The old impairment threshold is murky at best, since the FAS 5 and FAS 114 language under from FASB is being replaced, not modified, but replaced with the CECL standard. And the threshold of the restructured loan, the TDR, is going away next year as well. So when we need to individually assess loans is a good question that we're certainly happy to have that conversation with you guys on a one-off basis. But this is where you would manage those individually assessed loans, whether you do it at the loan level or at the bucket level, so to speak, the pool level. You can plug in those values here and let us know where it's coming from in the call report so we can properly back those values out of the collective pools so that we're not double counting losses. Once we've done that, we have a collective pool balance. We can calculate a CECL reserve. We can add them up. We can get a total CECL reserve here for the collective pool. Then we can layer in any reserve we have on held to maturity securities, which we also have a tab here for, which is, again, a very small piece of the puzzle, if any piece for the majority of community banks out there. It's really just held to maturity securities and only ones that have a real risk of credit default. So typically doesn't include any of your government guaranteed securities in there, really just kind of corporate debt that has real credit risk and some other things, but there's certainly a place where you can plug in any of that if you have concerns. And then also the reserve for individually assessed loans comes out there as well. And then the final piece is to consider any CECL reserve that we need for our off-balance sheet commitments, for our unfunded commitments. So if I head over to the unfunded commitments tab, this is where we would handle it. Again, another pretty small piece of the puzzle from a dollar perspective for most community banks, but something that we can't completely ignore. So we wanted to give you all a methodology for going about it. We start by taking your total unfunded commitments, which we can get from your call reports by segment, and then we work with you to net out any that meet the definition of unconditionally cancelable. Credit card, unused credit card lines are pretty much always unconditionally cancelable. HELOCs, sometimes overdraft commitments, most of the time, et cetera, et cetera. Whatever's left over is the net unfunded commitment. That's the portion that FASB sort of demands that we deal with from a CECL perspective. Then we have to jump through a couple mental hoops here, sort of, to estimate this, because in effect, they're asking you to try to estimate long-term future losses on loans that don't really exist yet, right? So we have to estimate the probability of funding. We do give you some good default guidance here that comes directly from the FDIC in their risk-based capital guidelines, because most people don't really have a lot of really good data on probability of funding just laying around. We give you some guidance on expected loss rates, were those loans to be funded. And so we work with you to do a calculation here and compare it to if you happen to have any current allowance already on your books, hiding in the other liabilities for the off-balance sheet credit exposures, and then you'll have some sort of a small surplus or shortfall there. And that works its way into the summary down below. That's the last thing we need to worry about. We add those up, we get a total sort of CECL requirement. We compare it to what your current value or balance is, and we let you know as of that point in time what your CECL surplus or shortfall would be if you were implementing CECL today. This would be that that day one accounting adjustment, surplus or shortfall, and then from day two on, this will get modified a little bit as we get into next year, where we'll be the calculation will be letting us know how much more or less we need in our reserve compared our ACL versus where it was yesterday. And then all the day two accounting works just like it does today, where we provision for the difference to keep the reserve where it needs to be. Trying to think of anything else I needed to point out on the tool here. You can certainly change peer groups by default. With the peer data, we're just using all the community banks in your state as your peer group, but you have complete control over the peer group you use. If you want to use your national UBPR peer group, a state-based community bank peer group, or a completely custom peer group where you say, hey, I want all the community banks, between $100 and $500 million in assets in these 7 counties that surround where we are. That's not a problem. That's extremely easy to do using our platform. You would go to the custom peer groups page here. You'd say, here are the 7 counties that I want. Here's the asset range that I want. Create that peer group, and then it would show up right here in your drop-down box. So very easy and pain-free to create completely custom and flexible peer groups. When you have everything the way you want it in a scenario, you want to make sure that you save it as a new scenario, give it a name, give it a date, and then you can have as many scenarios as you want. This drop-down box of save scenarios will go on forever if you want it to. And as a best practice, we highly suggest whenever you have new data and it's a new point in time, you go ahead and save it as a new scenario and give it a new date so that you can track and trace really how your reserve is changing under CECL as we go through this year and into next year. And again, as you save these scenarios, they remain historically intact and accurate as of when the date you saved them, right? So it freezes that data so that you can always go back 6 months from now. You can look at what it was like 6 months ago and have an accurate representation of what the conditions were like at the time. Sean, I'm not sure if there's anything that I overlooked or missed while walking through the tool here. I think we can handle the scale tool maybe with the slides in the presentation.
Yep, that sounds good.
All right.
All right, so let me come back to my screen. So we won't cover these today, but what we've done here in these next few slides is just kind of recap what Steve covered in the CECLSolver, and we just threw some of the call-out balloons there. Just thought bubbles, just kind of remind you of what's happening throughout the tool. So these are here for your reference, after the presentation, but just again, kind of recaps what Steve had mentioned. We've also included the, just again, some of those common Q factors that most of you probably utilize in some form or fashion in the ALLL today. Again, those will be perfectly appropriate as we move forward with CECL. But again, we've kind of listed those out here just in case you're looking for some additional environmental or Q factors. This, again, just another slide on those individually assessed loans, calling those out, as well as the HTM securities, and now the scale tool that I'll turn it back to Steve to discuss. Steve?
So last year, as everyone's probably aware of at this point, the Fed came out with what they call the scale tool, which is a sort of a very limited tool, designed for smaller community banks to help them on their way with CECL. It is not by any means, as they've said, a safe harbor. So there's no guarantee that that's something that would be acceptable in the eyes of your primary regulator or your auditors. But we thought it'd be helpful enough that we would go ahead and kind of faithfully recreate the Fed's methodology within our CECLSolver, so you could have it, if nothing else, maybe as a sanity check to your primary methodology, to have a little secondary methodology there to double check it and at least understand the mechanics of it and how it works. The scale tool does suffer from a number of limitations. The first of which is pretty obvious. It's extremely limited from a segmentation standpoint. The data is all focused. The driver of it is that disaggregated loan loss reserve data that the larger banks, all those $1 to $10 billion banks, are now having to file on their, I think it's Schedule RIC on their call reports, where they have to not just give their total reserve, but give their reserve by segment. But there's only 6 buckets. There's only 6 total segments. And so the scale tool is kind of limited to those 6 segments. And the other limitation of it is certainly that the scale tool is designed that it assumes that you are going to have losses that you're going to have to be reserved exactly like your peers. And then you have to let them know how you might be different from your peers. So it starts by assuming you're going to perform in the future like your peers have from a reserve standpoint in the past, and not really close peers, but larger $1 to $10 billion peers. So there are some methodological challenges, but we thought it would be helpful to be able to see the mechanics of it. And so we rebuilt it within our tool, and you can save scenarios and you can look at the peer data. You can change peer groups, so you can choose larger banks that are in your neck of the woods. And I know that I think the Fed provides some peer data, but it's not particularly flexible or convenient. And so we've made that a lot more convenient because we're very used to handling peer data in these types of tools. So that's the Fed scale tool to be used if and when you see fit. This page here just shows some of the data that we start with for the scale tool. This is just a page from our QwickAnalytics, the interactive financial platform that you would all have access to by way of having a subscription to the CECL tool. This shows you can pick a peer group, you can pick a geographic area, and you can see trends in reserve levels by segment for banks that are in that group. So it gives you some idea of long-term trends in your peers, or I use peers lightly in air quotes here, but it still can be very helpful to see what direction those reserves are going at the segment level. Sean?
Yep. Okay. So one of the things that, again, we get the common question as part of our tool, since we are calculating, or you're calculating, we can assist with calculating the warrants, is, just any prepayment assumptions. This is an area where, again, we think precision versus accuracy certainly needs to be heeded. It is a rabbit hole that, many banks tend to go down. I think the important point here is we always remind our banks any type of prepayment assumption is going to lower the warm. The lower or no prepayment assumption, right, is going to be a higher warm. So by default, it is going to be more conservative. But nevertheless, Steve has done some, research to try to provide some data regarding prepayment assumptions, and he will discuss those here now. Steve?
Yeah. So we were looking into this. We get questions all the time about what sort of assumptions are reasonable or acceptable for prepayment speeds, right? When you're calculating your warms, as Sean mentioned, if you don't take into account prepayments, you're going to be significantly overestimating your warms and kind of shooting yourself in the foot from a required reserve standpoint, right? The longer your warms, all things being equal, the higher your reserve is going to need to be, because we're having to reserve for all of the losses over the remaining lives of the pools. So if you have a longer remaining life, you're gonna accumulate more losses over time. So we don't want to overlook prepayments. Now, calculating prepayment speeds, doing prepayment studies on your historical data is another level of complexity over the standard warm calculations outside of it, because you have to track individual loans over a period of time. And even once you've done that entire study, you're still that's still only half the battle, because they're not asking for your historical prepayment calculation. They're asking for your projection of prepayments going forward, right? Looking forward. And as you know, prepayments have varied wildly depending upon the economic environment and the interest rate environment. So a more practical way to handle it, it just has the side effect of being a lot easier, is by looking at some industry guidance and basing our initial assumptions on that. So we looked around to try to find some good guidance on different loan types from a prepayment speed perspective. And the best we found for mortgage-related loans it comes from the FHFA, which publishes a prepayment monitoring report every quarter. There's a great single chart within that document. I think it's on page 5 or so. It's on this link that we have here, and also on our resources tab on the interactive tool, which takes all the Fannie Freddie loans in the country, averages them out for all remaining terms and coupons, and shows what prepayment speeds have been over a long-term trend. And obviously that number can be very low and very high, but taking a long-term average of that trend, in my opinion, is probably the best single starting point for a prepayment assumption, even better than doing your own prepayment study over a certain historical period in your bank's history. If you go to the next slide, Sean, we'll see kind of what that looks like. This is that chart from that, I think it was the first quarter FHF prepayment monitoring report. You can see prepayments have been as low as 5-10% and as high as 35%, all within the last 5 years. If you took a long-term average of that trend, you would find it to be somewhere in the 15 to 20% range. These are CPRs, so they're conditional or constant prepayment rates. They're 1-month CPRs, but they are annualized by definition. So these are pretty much exactly the kind of number you're looking for. It is an annualized prepayment rate. So that's a great starting point for mortgage-related loans. That certainly doesn't help, and the FHLB will not be FHFA, sorry, will not be very helpful on other loan types. So we did some other research for other loan types on the next slide. And we found some data from the Federal Reserve when they built the TALF facility way back in, I think, 2012 or whenever it was. They had a lot of research they did on prepayment assumptions for the TALF facility. It's something that they have continued to update on their website over the last decade, and so you can find it there on that link. But it gives some prepayment assumptions for some different types of loans that are not mortgage loans, equipment, small business, auto loans, etc. Those are typically done on a monthly, on what they call an ABS, which is a absolute prepayment speed, and it's a non-annualized value. So you'd have to take that monthly thing, annualize it, and then just by coincidence, if you do so, you end up finding yourself also within that 15 to 20% range on a general level for prepayments for most of these other loan types. So 15 to 20%, whether it's mortgage loans or some other business loans, we found is a pretty good starting point to use for annual prepayment speeds. And that's why we put this guidance together to give you guys, and when doing your WARM calculations, make sure you take into account prepayments. Start with a value like these, and then if you have some more better historical data and you can hone it, or you can get a a long-term prepayment study from your ALM or core provider, which you have faith in, then you can certainly modify it. But we thought this would be a good starting point. John?
Great. Thanks, Steve. So, obviously there's a couple of areas where we, cannot obviously get information from the call report. Those really revolve around your Q factors and calculating the weighted average remaining maturity. Now, in our tool, you have the option of doing this yourself, or we can assist you. Either way, we will provide, templates that you can use to calculate the WARM. You really only need a few pieces of data to calculate a WARM. So we work with our banks to, again, try to minimize or eliminate any anxiety around calculating these WARMs. How we do it are a couple of different ways. You can just send us an Excel file with some data. You can send us the ILDR file. Some of you might refer to that as the flat file or the loan tape or your trial balance. But again, just rest assured, one way or another, if you don't want to calculate the WARMs, we can assist you in calculating those either on a quarterly or if you do this on a monthly basis. This is an example of that flat file. It's an 82 field loan file. It's what you share with the examiners when they come in. Everything that's in that file is what we would need to calculate a WARM. So again, just understand that is a piece of information that we work with you to calculate. And again, if you want to unload that burden, we can do it for you. If you feel like there are instances, or if you feel like you want to do more loan level data, or build further segregations, we can assist with that as well. So again, in discussions with you, we can determine if that's necessary. For the almost every community bank, I would tell you this is not needed initially. It may be down the road, but right now it's probably a level of, again, precision that I would say the majority of you do not need. So next step, obviously two things. One, if you have any questions, please submit those now. We'll be happy to entertain any of those that you might have. Secondly, if you feel still a bit, like you need to have a little bit more one-on-one with your data, email us, call us. We'll schedule a Zoom call to walk you through your data in the CECLSolver so it can bring it to life. We can discuss any questions that you have. And then I think what's important and what we've seen very helpful for our banks as they've moved forward is for banks that sign up with us, and you can get started really in as quickly as a day once you return the agreement. But if you want, what we found is to be helpful is that first time or two, we'll put the WARM data in after gotten those calculated. We'll have the bank share with us their Q factors. We'll get those into the CECLSolver. We'll do a parallel compared to what is in your ALLL today. And that really helps bring your information to life. And so again, that's something that we're ultimately here. While we've designed this to be very do-it-yourself, we are certainly here to assist our clients, with that process. So, we're going to be here to make sure we get you to the finish line with the least amount of anxiety possible. So I'd encourage you, to call us, email us, even if there's any, existing customers on the call today. If you want to go through your data, just, schedule a time. So, we're here to help. We do have coffee talks on a monthly basis. Many of you may have seen advertising or marketing for this. This is our attempt on a monthly basis to further dive down into the CECLSolver, to take questions from our banks, address any common questions we might be hearing from our users. And so what it's ultimately kind of evolved into is a quasi-user group. We do these on a monthly basis. Our next installment is in October on the 14th. We will have a panelist, Paul Allen, from the accounting firm Saltmarsh in Florida. Paul's a dear friend of ours here at QwickRate, and he's agreed to come on again. This is his second go around, just to address any and maybe more of the accounting questions or just even transitional questions for that first day accounting, but as well as just any general CECL questions. So you'll have him in addition to Steve and me on the call here in October. So let me just double check to see if we have any questions. I'm not seeing that any have come up. If there are not, certainly thank you all very much for attending today. I'll leave this information up. If you want to do a demo with your data, call us or email us, and we'll be happy to schedule a time to go through it again, see your data on the screen, and again, see if we can help you with this transition to CECL. So on behalf of Steve, thank you all very much for attending today. Please let us know how we can help. And if nothing else, then we'll let you get back to your day. And thank you for spending some of it here with us today. Have a great day.